The Reserve Bank was saying, we won't raise interest rates until 2024.
Yeah.
Well, we ain't in 2024 yet. They've got a 425 basis point head start on us already. So there's a real, I think, economic rationale and actual sort of logic to saying things have changed. And the stage 3 tax cuts, not that they ever were fit for purpose, but they're woefully terrible now.
Yeah.
One for Mum, one for Dad, one for the country.
And there has never been a more exciting time to be an Australian.
Budgets are about choices, Fran, and you show what you value through the choices you make.
This is coal. Don't be afraid. Don't be scared. The Treasurer knows.
I want an economy that works for people, not the other way around.
We'll just end up being a third-rate economy, a banana republic.
Just follow the money.
G'day, and welcome to Follow the Money, the Australia Institute's podcast that explains big economic issues in plain English. I'm Ebony Bennett, Deputy Director at the Australia Institute, and just in case you weren't already worried enough about the cost of living, the Reserve Bank has just delivered its first interest rate rise under new Governor Michelle Bullock, lifting the cash rate from 4.1% to 4.35%. Bullock said of the decision that the risk of inflation remaining higher for longer has increased.
The decision that stops a nation.
After 4 months on hold, the Reserve Bank lifted the official interest rate by 0.25% today to
4.35%.
13th interest rate rise today.
Higher than expected inflation, the strong retail sales.
Inflation is too high for comfort.
Hard pill to swallow for many Australians already struggling to make ends meet.
Between rate rises and electricity, we shouldn't probably be at the Melbourne Cup, to be honest.
This will make life harder for people who are already doing it tough.
Now, that's not the sort of money you find down the back of the couch.
Mortgage stress is now the number one issue across the country.
We're certainly not out of the woods yet.
I don't think the RBA is actually going to end up delivering another hike.
The risks to inflation and the need for another rate hike are still there.
Be the last hike for this cycle.
It is entirely possible that another rate rise could occur in the next month as well, which is obviously just before Christmas.
But what needs to happen for the Reserve Bank to cool it with the rate rises? What are they waiting on to change? And how do interest rate rises impact the Australian economy? Are they really helping to cool inflation? To give us a clearer picture of the situation, I'm talking to the Australia Institute's Chief Economist, Greg Jericho. G'day, Greg.
Hi, Ebony.
First of all, can you give us a quick recap of what the RBA decided today?
Well, basically, the RBA, in deciding to raise interest rates to 4.35%, which now makes it 4.25 percentage points or 425 basis points since April last year, which is easily the fastest and highest the Reserve Bank has raised interest rates in over 30 years. They came to the decision, basically, they were saying inflation is not coming down as fast as they wanted. The economy kind of isn't slowing as fast as they maybe not wanted, but not as fast as they expected. Unemployment hasn't really risen much, and so they believe that after not raising rates for 4 months, which they are sort of classing a bit of, we had a bit of a wait-and-see period, that the signs are that inflation, because it's not coming down fast enough, they needed to raise rates to slow the economy more, reduce inflation more, and they acknowledge that this is going to hurt some, but it's for the good of the economy, apparently.
So speaking of it hurting some people, how will this impact everyday Australians out there?
Yeah, well, I mean, if you've got a home loan and the average sort of home loan around $650,000, say, that if this is all passed on, which it probably will be, it's going to add another $110 a month. And that comes on top of already about $1,450 or so increase in the average mortgage repayments over the past sort of 18 months. So it's another massive sort of increase, and we're looking at mortgage costs that have risen almost double in that period. And it's going to have the effect of slowing the economy because it reduces the ability of people who have mortgages to spend money elsewhere. I mean, that really is what it boils down to. The Reserve Bank raises interest rates to try and affect two things: households and businesses, especially small businesses. When it raises interest rates, that increases the interest rates of small business loans and their overdrafts. They can't borrow as much, or the cost of borrowing rises, so they're less likely to, say, put on new staff or to buy some new equipment or something. And that all has the impact of, one, reducing employment growth and also just slowing investment and things like that. But the other major one is it raises the cost of people paying off home loans. And a home loan isn't something you can avoid. You can't sort of ring up the bank and say, look, not this month, I'm a bit short. Do you mind if we go without this month? I'm good for it. They generally
frown upon that sort of thing.
Frown upon is probably a nice way of putting it. Of course, banks will always say, we're very careful about hardship, but let's be honest, you got to pay it. And because you have to pay it, that means you have less money to spend elsewhere unless you're going to go into debt. And most people generally don't increase the amount of debt. They would just sort of... they know that their income is kind of finite, and so that means there's less money to spend in the shops, essentially. And shops and on services are things that really employ people in Australia. And so if you've got less money being spent, that means you're like, well, I'm not going to hire another staff member, or actually let's cut back on shifts. So that reduces the amount of people getting paid, which in turn reduces the amount of money that people all up in Australia have to spend in the shops, and it just goes like that. And so it's really about trying to slow the economy.
Today's hike will hurt millions of Australian households. I've spoken to the National Debt Helpline. They are expecting a rise in calls.
People, they're wanting to do anything to keep a roof over their head. So they will go without healthcare, they'll go out without food, they'll go without non-discretionary items, nappies.
Charity groups preparing for a major spike over the next month. More and more families struggling with loan repayments.
Our frontline services are seeing up to a 35% increase on people who are coming through our door.
The hike leaving more families staring down a tough Christmas.
What is the Reserve Bank's overall aim, which you've just kind of explained? It's trying to slow the economy. If the point of that at the moment is to reduce inflation, how's it going on that front?
Yeah, well, this is where the theory hits the rocky road of reality. Because that theory about raising interest rates to slow the economy worked really well kind of back during the mining boom period, where there was a lot of good wages growth. People were kind of feeling flush. It didn't hurt that John Howard was giving us a tax cut every year. So there was lots of money just sort of gushing around the economy, and inflation was rising because people were spending pretty strongly. This time around, what we've got is the Reserve Bank raising interest rates to supposedly slow demand, and yet people are not spending, people are struggling, real wages are falling because wages growth is weak, and it's certainly wages are going up slower than inflation. So people are already doing it tough. People are already aren't able to buy as much with their wage as they were a year ago, even before you include the interest rate rises or the rent rate rises, which kind of flow on from that as well. And so it's kind of what I'd say is sort of a double whammy. You've already got households slowing how much they're spending in shops because they just their dollar doesn't go as far. They're spending more to get less, essentially. And then you're having your interest rate payments sort of go up by 50, 60, 70, 80%, which when you combine those two, you really are getting smashed. Yeah. And in a kind of unprecedented sense, it really is putting the brakes on household spending and the economy in a way that we really haven't seen for a very long time. And the problem is, so you've got that aspect of, one, the Reserve Bank raising interest rates to slow spending when spending isn't going fast anyway. So what the hell are you doing? And also, when you look at what are the main drivers of inflation at the moment, it's a lot of things that really don't care about interest rates, like oil prices and petrol prices. You know, the petrol price will not go down because interest rates went up.
If only it was so.
Yeah, if only. It'll go up or down because of what OPEC countries are doing, generally.
What's happening in the Ukraine and all that kind of stuff.
A slight lift in the rate due to fuel, electricity, rents and insurance premium increases.
Average Australians did not cause this inflation crisis, and they shouldn't be punished to solve it. Inflation figures are being driven by things that are out of control of the RBA and the Australian government, like petrol prices internationally, and things that are within the control of the Australian government, like corporate price gouging.
Another big driver in the September quarter was rent prices. And again, we know that rent prices are probably going to go up because of interest rates, because landlords will go, well, the cost of my investment loan has gone up. Yes, they could negative gear it, and maybe they should negative gear it more, but what you'll also see is they'll increase their rents because they, in a sense, figure that the renter is there to pay the mortgage, at least part of it. Other things, electricity prices, well, they didn't go up because people were out there demanding more electricity and we're keeping the lights on more than we have in the past. They go up because of a number of things, one of which might be the cost of actually producing that electricity through gas and coal, which again, don't care about interest rates. Santos are not looking at the Reserve Bank and going, well, I don't know what to charge gas prices this week. We'll wait and see what the Reserve Bank does. They don't care. The other one, property rates and charges, well, they sort of go up in line with house prices, but again, it's something determined by governments, not by people demanding more property rates.
Yeah.
And then another big one is insurance, and insurance again doesn't have anything to do with interest rates. Unfortunately, at the moment, it's got a lot to do with climate change. Insurance companies are looking at the coming summer and knowing it's going to be a hot one. And that is increasing the costs of house insurance especially. So all of these things aren't really affected by interest rates, yet they're what's driving inflation. So it sort of comes to us of thinking, well, okay, the Reserve Bank wants to slow spending that's already slowing to reduce inflation that isn't being really driven by households.
So, Greg, if that's the case, what are the risks of the Reserve Bank continuing to increase interest rates?
Well, having said that inflation isn't being driven by things that are affected by interest rates, that doesn't mean that interest rates don't have an impact. And because of this increase in the cost of servicing mortgages and the other sort of things that will come from that, like rents, that means that there's going to be less money spent on services, on goods, on things in the retail sector than there would have been, and that does actually slow the economy. Now, it might have an impact on inflation. It's not going to have too much of an impact on all those things I just mentioned, but it's going to have an impact on demand for goods and services, which unfortunately the impact on inflation mightn't be great, but the impact on unemployment, the impact on the actual economy might be great. And that's the big worry. The more you raise interest rates, the closer you kind of get to a breaking point where you think, oh, it's just another 0.25%, another 25 basis points, it doesn't matter. And it's like, yeah, that was the one that broke us,
Yeah.
And that's certainly what we saw in the 1990s, where they sort of kept raising interest rates, and obviously we're talking much different situation back then. We're talking 17%, not 4.35%, but it's still coming off a different starting point, and it was a case of things weren't slowing until suddenly they stopped. The Reserve Bank, governments always like to talk about the soft landing, and what they mean by that is slowing the economy but not crashing it.
Yeah.
And that's really tricky with interest rates, because interest rates, one, are a very blunt tool. They affect everyone. They affect every part of the economy, even though different parts of the economy some are doing well, some aren't doing as well. You don't sort of see the impacts right away. They can take a while to affect, and also they're cumulative. an interest rate rise in February takes a few months to flow through, and then you have an interest rate rise in March, and that takes a few months to flow through. But it's not like you have the interest rate rise in March and the interest rate rise in February is forgotten. It's still coming as well.
That's right.
And so that's the thing. It's this cumulative thing of slowing the economy, and sometimes the economies in the past we've seen when central banks have, and not just in Australia, have tried to slow the economy gently through interest rate rises, is they miscalculate and go, oh, we went one too many.
It's all in the name of rescuing the economy, but there are those who say it'll cause it to collapse.
I cannot believe that the Reserve Bank has put the rates up again so close to Christmas. We could end up in a recession. That's what I'm worried about, because I think this rate rise will start to create a massive flow-on effect for Australians who have mortgages which are way too high.
We really want to look into and examine whether improper lending practices occurred, not only through the banks but other lending organisations as well.
And what would that look like in Australia? Does that play out, first of all, in the housing market, do you think, or elsewhere?
I think more you'd see it in businesses, in certainly in employment. You start seeing unemployment rise. I mean, Australia's housing market, to be honest, is pretty damn resilient. So it would require a much higher rate of interest rates, I think, to sort of puncture the housing market, but it certainly could slow.
Yeah.
I mean, the weird thing is even during this period of interest rate rise, we're already seeing house prices start to kind of rise again.
Yeah.
Yeah.
It's really unbelievable,
it
isn't it?
Really is. It really is. And I think part of it is, I think we've just gone through a pandemic where you think, okay, the global economy stopped, and yet we had a massive house price boom. So there's probably a not illogical belief among people that probably house prices are good.
Yeah.
You know, that no government is going to let them crash, no Reserve Bank's going to let them crash, so they're probably a good bet. And that's probably right. It might be a risky way to think about it. But what we certainly will see is businesses go, I'm not seeing as many people shopping here anymore.
Yeah.
And the cost of me taking out my overdraft loan or things like that are rising.
Increased. Yeah.
The rents on my shop have increased because the shop centre, their rates have increased, and that's flowed through. And so it's a case of that's where we kind of see it. And the worrying thing is the Reserve Bank seems to be a little bit fixated on unemployment and wanting to get it up to close to 4.5%, which is only just a lazy 200,000 extra people unemployed.
Without jobs, Jesus.
They've, in their latest statement, they sort of point out that they're now expecting unemployment only to rise to 4.25% only, which is better than their previous forecast, and it almost seems like that is one of the reasons why they raised interest rates, because things are actually not going as bad as we thought they were, so we better, obviously the economy's doing okay. And it's, I think, where we also see the impact of these decisions and these rate rises is that it's not equal among people, and a real telling statement in Michelle Bullock's decision statement was, noting that many households are experiencing a painful squeeze on their finances, but then while some are benefiting from rising house prices, substantial savings buffers, and higher interest income.
Who does that sound like, Greg?
So, look, I mean, it really is, and this is something that has been quite clear, is that rate rises like we've seen over the past year and a half affect younger homeowners more, because they're the homeowners who took out a loan when interest rates were low. If you're, say, in your 50s, or someone like me who took out a home loan maybe back in, say, 2010 or 2015, so you're sort of 10, 20, 15 years into your home loan, you took them out when interest rates were actually a bit higher, and probably higher than they are kind of now. So, yeah, you've experienced the increase, but actually it's not too bad. You kind of can cope with it. You're going back to where you kind of were. Whereas if you took out a home loan in the last sort of 5 years, not only have house prices gone up so much that the size of your loan is
probably much
by
bigger.
a factor, much bigger. You've also haven't really benefited too much from the interest rates going down in the first 10 years. Yeah, you had the sort of the record lows during the pandemic, but now they've been completely blown away. You're the one who are really suffering. You certainly don't have big savings buffers because you're young. You're putting everything into your home loan because it's so damn big.
Yeah.
So you're certainly not the type who has a term deposit. You're not the person who is feeling rich because the value of your home's gone up, because actually they've kind of sort of moderated a bit of late. And also you're caring more about just paying off your mortgage than actually the value of your home and borrowing on the equity or anything like that.
Yeah.
And you certainly don't have any savings buffers because they've been wiped out, because even the Reserve Bank governor, or the previous one, Philip Lowe, pointed out that they know that savings buffers are very unequal. Those with higher savings buffers are the ones who, one, are less likely to have a mortgage, which is, and we're not talking people who are renting, but people who have paid off their mortgage.
Yeah.
And, we're talking older people. And, and it's not to sort of say that older people are to blame for the rate rises, but it's a case of it really shows
there's a big gap in who can withstand all these interest rate rises and who's going to be the most impacted by it.
You're lucky enough to have paid off your home and sitting on some savings, then actually, of course, this makes you better off.
Reserve Bank Governor Michelle Bullock is under pressure to raise interest rates this afternoon. Joining me is business.
RBA Governor Michelle Bullock says inflation has passed its peak but is still too high.
They've been trying to get inflation back down into the target by about the middle of 2025, and they need some more assurance that that's going to happen.
So, Greg, is this a sign that much is going to change under Michelle Bullock compared to Phil Lowe?
No, it pretty much seems same, really. As they say, it's the language is very similar. They're talking about, being resolute in their determination to keep interest rates under control. There really hasn't been a lot of change in the language of the statement. And it's something, Michelle Bullock said in her first Senate estimates hearing a couple weeks ago. The Reserve Bank really, when it comes to inflation, only has one tool, and that's interest rates, and it seems like she's willing to use it. And that is one of the problems. When you only have one tool, you kind of are tempted to use it rather than not.
It is beyond belief that the RBA would raise rates, even as in their statement today, they acknowledge that inflation has peaked and is coming down. And it also beggars belief that Treasurer Jim Chalmers would sit on his hands and allow that to happen.
At the beginning of the year, Anthony Albanese said that his New Year's resolution was to get down the cost of living. It's November and it's only gotten worse.
Everything is far more expensive, plus another 12 rate rises.
Especially those who have mortgages would prefer their mortgage rates to be static, but we're not going to be interfering in what the Reserve Bank has got to do. They're an independent organisation. As a government, we're doing everything we possibly can to bring inflation under control.
And so what does this mean for the government, which does not control interest rate rises, but nevertheless has an inflation problem? What are the options for government looking down the barrel of still this cost of living crisis and inflation still not under control?
Politically, it's not good. Politically, interest rates are terrible, and I think people have kind of forgotten that. It was a fairly big thing back in 2007 in the run-up to the election that the Rudd government won, because the Howard government had made such a great store on keeping interest rate low, and then after the GFC, interest rates were always going down, so it kind of died as a political thing.
Yeah.
Joe Hockey tried it sort of in 2013 and no one really paid much attention. But now it becomes a bit of an issue of what are you doing, and that I think we're going to see it probably play out a bit in the mid-year financial and economic outlook, or MYEFO as it's more commonly known, which is it's kind of the halfway budget update.
Yep.
And we know that with that, the government is going to be kind of releasing its response to a review of infrastructure projects.
Yep.
And because the IMF just recently came out with sort of a bit of a look at Australia and said one of the things you got to do, one, it said raise interest rates, which was nice of them, but also said the government should look at its infrastructure spending because the costs of that have blown out. To be perfectly blunt, the Howard government spent more on stupid things than probably was needed, and because you've got all this money committed to all these projects, that's actually
The Howard government or the Morrison government?
The Morrison government. Oh, my God. Yeah, Morrison government, not
all
the Howard
that talk
government.
of interest rates really took you back, Greg.
And so you've got a case of, and, this is one of the things we certainly at the Australian Institute have been pointing out, we've got a situation where we've got massive investment or infrastructure projects that occurring because of the mining industry that are not actually producing any good for the economy, and in a sense they're crowding out valuable infrastructure projects that could help the economy. And so because we don't see much anticipation of the government reducing the number of coal mines or gas mines around the country, what they're probably going to do in the first instance is take a bit of an axe to these infrastructure projects. And partly it'll do it because a lot of them aren't theirs, in a sense.
The so-called Stage 3 cuts come into effect in 2 years' time and will see income between $45,000 and $200,000 taxed at just 30%, costing the budget all up more than $240 billion by the early 2030s.
When it comes to the Stage 3 tax cuts, our position hasn't changed.
And there's not kind of universal support for that approach. We did see today the Queensland acting Premier, Stephen Miles, come up with a different suggestion for the federal government. What was that,
a
Greg?
really good one. One that we'll certainly be championing, and that is maybe do something about Stage 3, which, when we're talking about infrastructure projects and the cost blowouts, the report is that over the next 10 years, the cost of infrastructure is blown up by $33 billion. Well, the cost of Stage 3 tax cuts in their first year alone are $21 billion. and over 10 years are $320 billion. So, the Queensland government, who is sort of looking at a lot of their infrastructure projects, are going, hang on, before you start axing these, how about you deal with your own terrible policy, which is the Stage 3 tax cuts, which are highly inflationary because, and this is where it's really key, think about that list of people who the Reserve Bank said are basically doing okay and are still spending well.
Yeah.
People who own homes, people who have got, big savings buffers and are doing well out of deposits and big term deposits. Well, they're kind of in the wealthier, richest end of the scale, and they're the people who are going to be getting the biggest tax cuts from the Stage 3 tax cuts. So that is just going to add to inflationary pressures in a massive way because you're handing people already kind of doing okay, haven't suffered from interest rate rises like everyone else, and you're giving them up to $9,000 extra just for doing nothing. So certainly if the government really wanted to think about actually taking charge of government finances, and rather than just being saddled with what the Morrison government gave them, they really should be starting to look at Stage 3 and go, okay, inflation and interest rates are a hell of a lot different than they were when we made this promise. Back when the government made the promise, the Reserve Bank was saying, we won't raise interest rates until 2024.
Yeah.
Well, we ain't in 2024 yet. They've got a 425 basis point head start on us already. So, there's a real, I think, economic rationale and actual sort of logic to saying things have changed. And the Stage 3 tax cuts, not that they ever were fit for purpose, but they're woefully terrible now.
Yeah.
Let's do something about them. And as we point out, we can still deliver good tax cuts to most people, but they won't have that inflationary aspect. More, it's about actually keeping people afloat who are getting absolutely smashed.
Well, we might have to leave it there. Thanks very much, Greg.
No problem, Zeb. Great to chat.
This episode was recorded on Tuesday the 7th of November 2023, and things may have changed since recording. You can visit australiainstitute.org.au for all our latest research and content, and we're on Twitter, or X as it's now known, at the Oz Institute with an AUS. My handle is Ebony_Bennett with a _N_T. Greg is at Grog's Gamut. Our producer, Jennifer Macy, is at Jennifer Macy with additional editing by Emily Perkins. Our theme music is by Jonathan McFeet from Pulse and Thrum with additional music from Blue Dot Sessions. Thanks for listening.